All right, hello, everyone. Welcome to today's weekly market check-in with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith. Derrick is the head trader at T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. As a registered trader with T3 Trading Group, let's quickly take a look at his current positions as of the start of our live stream here today. Derrick, happy Monday. How is your day of trade going so far?
It's okay. Today's been a little bit slower feeling for me, a little bit more relaxed, or maybe I'm just relaxed after a good weekend. Got a lot of exercise, a lot of hiking in this weekend. So yeah, feeling really good. But this market is strong and it's kind of going sideways, and the technicals look bullish, and we'll see if we ever break out or not.
All right, good stuff. Good to have a refreshing weekend under your belt for a fresh Monday of trading. All right, the title of our stream today is Trade Tensions in Focus. The market is back focused on trade tensions between not only the US and China, but also the steel industry with new tariffs being announced there as well. So what does the market response to the latest tensions between the US and China tell you about how the market is feeling about the trade picture overall? The NASDAQ, last I checked, had turned green after being down today. And like you mentioned, we're a bit sideways, flat-ish on the S&P 500 and down just a bit on the 200 points on the Dow. So much better than this morning. So what is the market
A little bit better than this morning. Trade tensions, I guess, are in focus in the media because they don't seem to be in focus at all for the market. This market has just been incredibly resilient. What we have seen here is just a quicker buy the dip mentality on anything that's tariff related. Some people are calling it the taco trade. Take that for what you will. But it started where really the China-U.S. tension headlines came out in a major way on Friday. And I feel like those exact same headlines, if they had come out, I don't know, a month ago, would have brought us down it would have been a big down move that would have lasted several days. And over the course of the last month or so, every time we see an escalation in tariffs, that dip seems to be smaller and more quickly bought up. To now the point where we're at on Friday is we went down for 20 minutes on seemingly really bad headlines of the United States is saying that China is violating the trade agreement that they put together in Switzerland, and now China is retaliating and saying that the United States is actually in violation. If you remember, the China tariff pause occurred between the May 9th and May 12th. So it causes really big gap up on Monday, May 12th. Huge gap up. So a pause on US-China tariffs brought us from basically SPY 564 to 583. It was almost a $20 up move. And then when we see these headlines come out on Friday of, things are looking terrible, we're not getting a trade deal done, there's no progress, China's violating the agreement, the United States is violating the agreement. Off of that, we move down, I don't know, here, I got my charts up on my other screen, I could try to pull them up. But we pulled down $4 or $5 in the SPYs over the course of 20 minutes. And then within 45 minutes after that, the move down had been 100% reversed and we're back up. So this buy the dip mentality on negative news, it's just happening faster and faster. And I feel like that leads to one of two things. Either it's setting this market up for a really big break higher through this. We've more or less been going sideways for a couple of weeks for the S&P and the NASDAQ. There's resistance in the SPYs around 593 to 595. So either this quick dip buying mentality has this underlying bid that's so strong that eventually we wear out the overhead supply that has been causing the selling here and we get a massive breakout, or eventually the actual opposite happens where those dip buyers run out of steam. And I've been actually incredibly impressed by the resilience of this market last week and again this morning. Last week, particularly at the end of the week, it seemed like we were seeing one piece of bad news after the next, and the China-US one being a big one. Then today we had the ISM manufacturing number that missed expectations. It shows that manufacturing is still in a contraction, yet prices paid was higher than expected. So I don't think that ISM manufacturing is the most important economic number in the world, but it did still show like some degree of actual stagflation in those numbers. And it was the same thing again today. Market went down this time, not on trade tensions, but on an economic number. We went down for literally 20 minutes. We went down from 589 in the SPYs to 585. It was a $4 down move in 20 minutes off that number, more or less. Actually, we were already selling into it, if I remember correctly. We were already selling into it. The number came out at 10 o'clock. We dipped a little bit further from where we were. And then within a half hour, the market was basically testing the high of the day. The resilience of this market is mind-blowing. And again, it's going to lead to one of two things. You hear me say all the time that markets work in periods of expansion and consolidation over time. Right now, we're in a consolidation period. We're in a range. This aggressive dip buying, which seems to be primarily coming from the hedge fund cohort that has been underinvested in this rally, either sets us up for a big breakout of that resistance level, which leads to an expansionary upside move, or eventually we get another piece of bad news, but the dip buyers are running out of steam to be able to buy that dip. Some people attempt to buy it, but we break a little bit lower, and then those people are out of the money. They begin to sell. That breaks us a little bit lower. Same deal, more stops trigger, more selling comes in, and the consolidation pattern breaks to the downside for the expansionary move. And the technicals would say that there's a higher probability between those two different scenarios of us breaking up. That's what the technicals say. I think that if you are 100% looking at charts and 100% looking at technical analysis and you're not doing any additional research, you probably would put that probability a little bit higher than it should be. But I do think that which way do we break out of this consolidation? More signs point toward us breaking up than breaking down. But I won't be surprised at all if we break down. And if we can get below the low from a week ago Friday in the SPYs, you got to start by breaking this past Friday's low. That's a first starting point. But if we can break the low from a week ago Friday, which is SPY 575 spot 60, I think that you're getting down to some prices where the selling will really begin to feed on itself. But that's the question. Which way is this range going to break? I don't have the answer, but I have been incredibly impressed by how well this market holds up in the face of recent bad news. We don't go down for anything.
All right. Somebody in the comments said we will break down back to April low to retest. So we'll see. All right. The other trade news that's in focus, besides the ongoing tensions with the U.S. and China, are the steel tariffs. Trump announcing he's going to increase those tariffs on foreign steel to 50% from the current 25%, sending many steel stocks in the U.S. Surging. Are you trading any of the steel stocks? I don't think so, based on your positions. No.
I don't have any positions in any of them. I do occasionally trade CLF. I do occasionally trade STLD. I haven't really traded United States Steel in a long time, ever since all the buyout shenanigans has been going. It's just been too much kind of macro risk for me to be involved in that name. I think that while I don't trade the steel stocks directly, it's just another piece of broadly negative information for the U.S. economy that the market is completely ignoring. I saw that so like the one country, really the only country so far that we have a trade deal done with is the UK, and that was announced with much fanfare. And supposedly the UK is very upset because we had agreed to be able to buy their steel on zero tariffs, and now we're announcing these tariffs and no one knows exactly what's going on. But it's just another piece of information that the market is ignoring. You would think that the one trade deal that we have done with the UK, if all of a sudden there's an asterisk at the end of that trade deal because of steel, that would just be one more degree of uncertainty for this equity market. Yet we still don't break down. So for me, it's just I would describe it as another brick in the wall, to use a Pink Floyd analogy. I was talking to the team about this a little bit this morning in the virtual trading floor. One of the most interesting things to me about the stock market is how things just don't matter, and they don't matter, and they don't matter, and then all of a sudden they do. It's been a real constant theme I've seen over the course of my career. And a lot of the times what makes them all of a sudden matter is that the market dynamics for selling eventually lines up with that negative news. And you'll see it happen all the time where, let's say hypothetically, and I'm not predicting that this is going to happen, the market starts to break down on Wednesday. And I'm just kind of making that day up. And let's assume for a second, even though we have an important ISM services number on Wednesday, let's assume that this breakdown is not related to that specific economic number on Wednesday. All of a sudden we start to break down. You will see the financial media begin to assign reasons for the breakdown that are the exact same things that we've already known about and we've already been speaking about for the last couple of weeks. It's just all of a sudden the market occasionally decides it cares. And then you see the financial media like scramble to assign a reason behind the down move. And a lot of times they're citing reasons that this isn't new information. This has been out for days. It's been out for a week or two. But all of a sudden the market just decided it cared. So when you're looking at steel tariffs, or when you're looking at China and the US tensions, when you're looking at the ISM manufacturing number that came out this morning, these are all, it's just one bad thing after the next. Yet the market is, for the moment, completely ignoring it. But watch how all of a sudden there's a good chance that the market just decides it cares one day. And then all of these exact same things that we're talking about right now are going to be right on the forefront of the reasons why we're going down.
I feel like a number the market might care about, we'll see, is Friday's jobs report. This jobs report feels really important, with the market trying to figure out what the Fed is going to do this year. The Fed, of course, at this point, inflation is on the right track. Jobs are still holding up, so the Fed definitely can't be cutting rates. The Fed looking for some signs of weakening in the labor market. With some of the government layoffs and some of the more widespread layoffs that have been happening in the past few months, I think the April jobs report might be the first where we are seeing some of those numbers, which will be important for the Fed to get a feel on what the job market is looking like. This jobs report comes before the next Fed meeting, and the next Fed meeting includes an SEP, Summary of Economic Projections, which makes it a more important Fed meeting. How are you feeling heading into this Friday's jobs report, and whether the market will care or not?
So what I was asking myself coming into today was, all right, so last week was the end of the month, and sometimes there's some more wackier, stickier price action on important days like the last day of the month. And I was so impressed, like I just said earlier, about how well the market is shrugging off negative trade news now, as if it doesn't matter at all. So coming into this week, the question I was asking myself, well, this week is a really big week for economic numbers. That we had, again, ISM manufacturing this morning. We've got services on Thursday. I think maybe JOLTS is tomorrow. And then we've got the really big number, the payrolls number on Friday. So I was like, all right, the market for the moment is ignoring any new headlines. I think that they want to see hard data that actually shows that things are getting worse at this point. We've seen the soft data that things are getting worse. We know the economic theory that tariffs are bad for the economy. The market's getting tired of the narratives. They want to see it in the hard data. That was kind of my thought process coming into this week. And then again, lo and behold, I know that the ISM manufacturing number is not the most important number in the world, and it tends to not be the most market-moving number in the world. But I thought that the number that came out this morning was pretty bad. It was a miss. It showed that manufacturing in the United States is in a contraction that is worse than expected, yet prices paid, which has a read-through on inflation, was higher than expected. That's not good. And again, market completely ignored it. Now, you're 100% correct. The jobs number on Friday is like the Super Bowl of the numbers that we have this week. It's the most important one. I think that 125,000 or 130,000 jobs added and a 4.2% unemployment rate are the numbers that are expected. I read one analyst note this morning, I don't remember exactly who it was from, that said their whisper number, if you will, was a little bit lower than the general consensus. And they think that if the number were to come in like under 70,000, then the market would really, really wake up and get rocked. If it's a smaller miss, like a small miss might actually just be ammo for the Fed to be able to cut, but a big miss on expectations, and expectations is already going to be showing a slowdown in new hiring. But if it's a large miss, if it's like less than 70,000 on that number, then it isn't necessarily a positive. Like, okay, we're slowing down a little bit, but it's not the end of the world because the Fed can cut. It's, ooh, are we slowing down dramatically? Or are we slowing down drastically where the Fed is too far behind and they've missed their opportunity to cut? It's going to be too little too late, and the economy really begins to deteriorate. So that's the most important number on Friday. We'll see what happens, and we'll see what the price action does this week into that number. But just to repeat myself, like I just find myself repeating myself over and over and over again these last couple of weeks as we've been stuck in this range. This market is incredibly resilient. It is ignoring every possible bad piece of news you could think of.
All right, you mentioned it. Today is the first trading day of a new month. It is officially June. I cannot believe it is already June. This year is flying by. So give me your review of your trading in May and the overall market in May, and kind of your expectations for June. June tends to be a bit of a quieter month than others in the year for the market, as people kind of go on vacation and things like that. So what do you feel about May and June?
Cool. Let me pull up the screen share here real quick.
Yeah, definitely. And any specific ideas you're looking at as well also.
Sure. So if you remember, when we did our show here on Monday, April 21st, the market was breaking down again. It looked like this could be like a lower high, and maybe we're going to test these lows. And I was saying, no, I think this smaller dip here is viable. It was not a small dip, but small compared to what we had seen earlier that month, because the market is set up for a positioning squeeze. That's what we were looking for. That's what all the signs pointed towards, a major systematic positioning squeeze. And it led to an incredible move. May, which just wrapped up, is the strongest May for, all these statistics. There's been all these statistics for April and May of being some of like the best and the worst and all this stuff. But May was like the best month for I think the S&P since I thought you lost me for a second. Pretty much the entirety of that move in May actually happened in the first 2 weeks. It was the first half of the month that totally brought us up. That was the positioning squeeze. The second half of May, we haven't done anything. So for me, the month started great. April ended great. And I had been 100% net long when I was looking for that positioning squeeze on April 21st. But the degree of the move higher and the duration of the move was more than I expected. So I did start to give back some P&L in the last leg. This week hurt me. The week where the United States paused with China, that week hurt me. At that point, I had turned net short. 570 was my reach target, really. 570, 573 was my reach target on the S&P for a positioning squeeze. We got to it. I had turned short, and then we got the headline. And I do a lot of positions overnight. We got the headline over the weekend where we gapped up huge. I was down a lot of money that day because I had short swings that were on, and we were off highs and off the 570 resistance high that I was looking for. So I got burned on that, and that just led to a wild 4 or 5 day squeeze basically that entire week. It was one of the strongest weeks I can remember, where the market was just extended and kept going higher and extended and kept going higher and extended and kept going higher. That week hurt. So I got her a little bit that week. And then ever since then, we've been range bound, which has been frustrating because I've wanted this market to give a little bit of a deeper pullback. And we did get one small pullback a little bit over a week ago. But I actually trade range as well. So while the range has been frustrating, I've got longs on and I've got shorts on, though I am net short. And I'm able to trade the range well, where I'm able to make a little bit of P&L for myself every single day recently while I'm waiting for that next move. So that's kind of the May recap. As we go into June, so June is seasonally the worst month, the third worst month of the year. I think August and September are the worst two. Someone should fact check me on that, but I know that for sure June is the third worst month of the year. I think on like a 20-year look back or so, June averages being positive about 0.5%, like 0.55% or so. So June basically tends to be a flat month. Sometimes it's up, sometimes it's down, but it averages out to being flat. I don't have high expectations for June insofar as market continuation, to be honest.
You are right. It's June, August, September, the 3 worst. So good job.
Perfect. Thank you. I don't have high expectations for the month of June here. Obviously, again, we have to see how this economic data plays out. We're in this range, but I wouldn't be surprised if we saw like a volatile yet sideways month. Originally, if you circle back about a month or so ago, I had thought that the beginning of June, basically this week, is when we would really begin to see the impact of these tariff policies in the economic numbers, like really the May month being the first month you see it, but you only actually see that in June when the numbers are actually announced. I think that we'll see a little bit of the impact, but a lot of information points to it really being a month out still. If you look at like Walmart as an example, Walmart's earnings report, and Walmart obviously would be one of the companies that are most impacted by tariffs in terms of their margins getting squeezed or them having to increase prices, which therefore means that people are potentially buying less of their goods. Walmart had said in their earnings report that most likely they would only begin to start increasing prices on their products that they import into the United States at the end of May. So and that's just one company, obviously, but if they're only going to really begin to take action that impacts the customer at the end of May, then you're not really going to see the impacts of tariffs too much yet in the May numbers. A little bit of front running. So it's probably going to be more in July for the June numbers that we see that. But the interesting thing about July is one of the strongest months of the year. You get a lot of inflows into the stock market, especially if you have an up market into it. You get a lot of inflows into the stock market in January for the new year and July for the second half of the year, every single month. And that helps to make July one of the strongest months that are out there. You know, they have that saying, I think we talked about this on your show, sell in May and go away. Right. Well, that's a little bit of a misnomer because we can get a lot of great volatility for traders over the course of the summer. But when you think about the historical seasonality, like we're just talking about, well, May actually turns out it's typically a decent month for the market, though this past May was incredibly strong. June is flat. July is very strong. And then August, September tend to be a little bit weaker. So, you know, we'll see what happens. July might be interesting because that month tends to be so strong, but we might also be really seeing the impact of tariffs and those policies into the economic numbers for the first time. And it's also when that July 9th date comes around, which is when the pause of the 90-day pause is supposed to end. Is the administration going to extend that pause further to give everybody more time for these deals? We don't know yet, but I would expect that as we get through June, people might start getting a little bit nervous about it if we haven't had any updates by that point. So broadly speaking, to directly answer your question for June, I'm kind of expecting a sideways-ish month. I want to say sideways and down, but the technicals are so bullish right now and the market's so resilient that I don't want to make calls that are really contrary to the technicals. I need the market to prove to me that it's breaking lower before I can be comfortable with any sort of a down call. So we can do everything we're doing right now. We can talk about the reasons and the thesis and the economy and all this stuff. At the end of the day, price is what pays. Let the price be your guide. Know your resistance level of this range, know your support level of this range, and whichever way we break up or down, then you can take action accordingly and you can put your trades on and manage your risk appropriately and put yourself in the position for bigger reward.
All right. Good stuff. All right. I'm going to let you go. Derrick is a real trader, so we got to let him get back to that. So you can go to t3live.com/DOLive if you'd like to get Derrick's free ebook. Again, he's the head trader at T3 Trading Group. His ebook is about the benefits of prop trading and how you can get involved yourself with him and the team there. So you can go to t3live.com/DOLive to download that free ebook. Derrick, have a great week. I hope it is profitable for you and exciting, not too boring of a week. And I'll see you next week. Have a good one.
Thanks, Greta. See ya.